The moment the amount of money in your bank account crosses a certain line, your bank starts watching you on behalf of the federal government, and it is legally forbidden from telling you it is happening.
There is a dollar figure that triggers an automatic report to a federal agency most people have never heard of. There is a second report that has no dollar figure at all and can be filed on a withdrawal as small as a few $100s. And there is a brand new reason banks are now pulling seniors into a back office and freezing their own money for up to 15 business days. None of it is explained to you when you open the account, and none of it is on the statement you get in the mail. Here is the part that catches good people. For almost everyone watching, the report itself is harmless. It is routine paperwork that goes nowhere. The thing that destroys retirees is what they do the moment they find out the rule exists. Because the instinct that feels the safest is the one that can turn your own legal savings into a federal investigation. What I am going to walk you through are 7 things about your own bank account that the system will never sit you down and explain. Every one of them is real. Every one of them is happening right now in 2026, and the last one is the quiet mistake that costs families more money than all the others combined, and almost nobody sees it coming. Stay with me to the end because the final move I am going to give you takes about 10 minutes, and it protects everything you have worked your whole life to save. Number 1 is the $10,000 rule, and you need to understand what it actually is before you can stop being afraid of it. Under a law called the Bank Secrecy Act, which has been on the books since 1970, every bank and every credit union in this country is required to file a report any time you deposit or withdraw more than $10,000 in cash in a single day. That report is called a currency transaction report, and it does not go to the IRS. It goes to a bureau inside the Treasury Department called the Financial Crimes Enforcement Network. Your bank files it, not you. You do not sign anything, you do not fill anything out, and you will probably never know it happened. The bank has 15 days to send it in, and it keeps a record of it for 5 years. This happens millions of times every year, and the overwhelming majority of those reports go absolutely nowhere. Nobody calls you, nobody knocks on your door, nobody freezes anything. A currency transaction report is not an accusation, and it is not an audit. It is a piece of routine paperwork. If you sell a car for $12,000 in cash and you walk it into the bank and deposit the whole thing, a report gets filed and nothing happens to you. I need you to hold on to that fact because the next thing I'm going to tell you is where people walk straight into a trap. Number 2 is the single most dangerous mistake a retiree can make with their own money, and it has a name. When most people hear about the $10,000 rule for the first time, they think the same thing. They think, well, I will just deposit $9,000, or I will break it up and bring in a few thousand at a time across the week. That decision to deliberately keep your deposits under the line is called structuring. And under federal law, Title 31 of the United States Code, Section 5324, structuring is a felony. Not a fine, not a warning letter, a federal crime. And here is the cruel part. The money does not have to be dirty. You do not have to be hiding anything. If every dollar is clean, legally earned, legally inherited, legally gifted to you by your own children, and you simply break it into smaller pieces to avoid the report, you have committed the offense. The penalty can be up to 5 years in federal prison and fines up to $250,000, and the government can seize the entire amount through a process that does not even require them to charge you with a crime. There are documented cases of small business owners and widows and ordinary retirees who had their life savings taken by the government, even though the money was completely legal, simply because their deposits looked like a pattern. The rule that protects you is simple. Deposit your money all at once, every dollar of it, and keep a record of where it came from. Never break it up to stay under a number, because the act of trying to stay under the number is the only thing that turns honest money into a federal case. Number 3 is the report that has no limit at all, and most people have never heard of it, On top of the $10,000 report, there is a second one called a suspicious activity report, and this one has no minimum. There is no floor. A bank can file a suspicious activity report on a transaction of $500, $200, any amount, if the behavior looks unusual to the software that watches every account. And it is a federal crime for a bank employee to tell you that one has been filed against you. So you could be flagged this week and have no way of ever knowing.
What sets it off is not the size of the money. It is a change in your normal pattern. If you have taken out $300 a week for 15 years and you suddenly ask for $8,000 to pay a contractor, the system flags the deviation. It does not know you are putting on a new roof. It does not care. It flags anything that looks different from your history. Anything that looks like the round numbers people use when they are trying to stay under the line. And any large deposit that does not match what the bank knows about your income. This is exactly why you never want to walk in with an unexpected pile of cash and no explanation. Bring the paperwork that proves where it came from, and the flag quietly resolves itself. Number 4 is the newest one, and it is the reason you may have heard that banks are freezing senior accounts. In the last few years, banks and brokerages have been given the authority to put a temporary hold on the account of anyone 65 or older the moment they suspect that senior is being financially exploited. The hold can last 15 business days, and it can be extended longer than that. It was written with good intentions, to stop scammers from draining a grandmother's savings before anyone notices. But the same rule means that a perfectly clear-headed retiree who walks in to take out $20,000 to help a child buy a home can be pulled into a private office, questioned about who the money is for and whether anyone told them to make the withdrawal, and made to wait days while the bank decides whether to release their own money. There is no age at which the bank stops treating a large withdrawal as a possible scam, and arguing with the teller does not speed it up. The way you stay ahead of this is to tell your bank before the big transaction, not during it. If you know a large withdrawal is coming, call the branch, let them note it on your account, and name a trusted contact person the bank is allowed to call. That one step turns a multi-day freeze into a 5-minute conversation. Number 5 is the $250,000 line that most seniors have never checked, and it is about protection, not punishment. Every account at every bank is insured by the Federal Deposit Insurance Corporation, the FDIC, but only up to $250,000 per depositor, per bank, per ownership category. If you have $300,000 sitting in a single account at a single bank, and that bank fails, $50,000 of it is not insured, and you can lose it for good. People think bank failures are something from the history books, but in 2023, this country had 3 of the largest bank failures it has ever seen inside the span of about 10 weeks. The depositors who were under the limit were fully protected. Anyone over the limit was at risk and only got rescued because of a political decision that there is no law forcing anyone to repeat. If you are holding more than $250,000 in one place, you can spread it across more than one bank or across different ownership categories at the same bank and bring every dollar back under the umbrella. It costs you nothing, and it removes the risk entirely. Number 6 is the quiet mistake I promised you, the one that costs families the most, and it is almost always done out of love. At some point, a well-meaning person tells a widow or a widower that the simple thing to do is add one of the children to the bank account so they can help pay the bills, and so the money passes to them easily later. It sounds reasonable. It is one of the most dangerous things you can do with your money. The moment you add your son or your daughter as a joint owner of your account, that money is legally half theirs, which means if that child gets divorced, the account can be pulled into the divorce. If that child is sued or has a car accident or owes back taxes or files for bankruptcy, a creditor can come after the money in your account because your child legally owns part of it. Any one child you add can legally withdraw every dollar without asking the others. And I have seen that tear families apart after a parent is gone. It can disrupt your ability to qualify for Medicaid. It can create gift tax complications, And it can quietly override everything you wrote in your will, because a joint account usually passes straight to the surviving owner no matter what your will says. The thing that was supposed to make life simpler ends up handing your money to a lawsuit, an ex-spouse, or one child instead of all of them.
Number 7 is the fix for all of it, and it is the 10-minute move I told you to wait for. Instead of adding a child as a joint owner, you ask your bank for something called a Payable on Death designation, a POD. You stay the only owner of the account for your entire life. Your children have no access and no ownership while you are alive, so no creditor of theirs can touch it and no lawsuit can reach it. But the moment you pass away, the account goes directly to the people you named, immediately, without going through probate, without a court, and without a lawyer. It does everything people think a joint account does, with none of the danger. It is free to set up, and it takes one short conversation at your branch. And while you are having that conversation, fix the amount too. The honest answer to how much belongs in a normal checking or savings account is 3 to 6 months of your living expenses, which for most retirees is somewhere between $15,000 and $25,000, and not much more. Everything above that is being watched. It is barely earning anything, and it is losing ground to inflation every month. Move the rest, in your own name, into a high-yield savings account that pays around 4%, into treasury bills or savings bonds that you can buy directly from the government through a website called Treasury Direct, or into certificates of deposit spread across several banks, so every dollar stays insured. You keep full control, you keep full access, and you earn real money on savings that used to just sit there being watched. Let me bring all 7 together, because there is one thread running through every single one. The $10,000 report exists, and the bank will not explain it. The structuring law can punish you for trying to be careful. The suspicious activity report can be filed on any amount, and you will never be told. The bank can freeze your own money for 15 days in the name of protecting you. The insurance only covers you up to a line you have probably never checked. The joint account you set up out of love can hand your savings to the wrong person. And the simple fix for most of it is sitting at your bank waiting for you to ask for it by name. None of this comes looking for you. The bank does not call you to lower your risk. The government does not write to tell you how to keep your money safe. The system is built so that everything stays exactly where it is, working quietly against you, until the day you decide to stand up and move first. You now know what the line is, you know what not to do when you cross it, and you know the one designation that protects everything. The only thing left is to make the call. I will put all the form names, the website, and the details you need in the description below. So do one thing for me. Send this to one person over 60 who keeps most of their savings sitting in a single bank account. Your mother, your father, your sister, your neighbor, the friend from church who just lost a spouse and is about to add a child to the account because someone told them it was the easy thing to do. The odds are very good that at least one of these 7 things is putting their money at risk right now. And one share from you could save them thousands of dollars and a freeze they would never even know was coming. That is what we are here for. I will see you in the next one.